Hi, my name is George Dagnino. I'm the editor of the Peter Deck portfolio. Most investors don't have the information and the resources to study and know about the future of companies. I saw people, team from large investment houses to review with the chairman of the board and the executive committee of companies where they show the plans, pricing, strategies, products, investments, and the future that the company is going to go. They ask questions. They know all the ins and outs, the risk and opportunities for a given company. The average investor does not have this information, and the average investors can look at the historical data, but they are not useful to predict the future. So what I would like to show you is a technique that helped me, quite frankly, to find out where the big money is going and when a big money is leaving an investment of a company. This is what is the purpose of this video. What is the main point, in investing? In investing, you want to invest in stocks that outperform the market because if you don't invest in those stocks, then the second best alternative is to buy SPY, the index of the S&P 500, because every other strategy, by definition, is going to underperform the market. So either you buy with companies with rising relative strength, that is, they're growing faster than the market, or otherwise you're better off by the average. Again, the technique that I would like to show you in this video is how to do that. Now, it always helps to understand where you are. It's not important, it's not crucial, but it helps to understand where you are in the business cycle. Why? Because in this period when the economy slows down and here is contracting, the best investments are defensive sectors. Instead, when you are in phase one and in phase two, as I showed several times, the best sectors outperforming, the best stocks outperforming the market are the cyclical stocks. So knowing this framework, it helps in the selection process. Another thing that helps is to know the trend of the market. I use in my service many indicators like this one based on advances and declines. They're technical indicators, but as you can see, they give you a good idea when there's above this red line that the market is going up. When it's below the trend, this red line, you have to be careful and more defensive. Here in this area, uh, you are more aggressive. And again, this is not updated as of the late, so this doesn't tell you what I think about the market right now. This is just to show you that it helps to have a timing indicator that tells you what is the likely direction of the market in order to be a little more or less aggressive in how much money you invest. Okay, this is the first example that I would like to show you. The green line, of course, is the price of XLP. XLP is the ETF for staples. The yellow line is just the 50-day moving average. It doesn't have any meaning timing wise. It just gives the direction of the price. The important indicator is at the bottom. The green line is the price of XLP divided by SPY. If the ratio increases, it means that XLP is appreciating faster than the market. If, on the other hand, the relative strength declines, it means that SPY is rising faster than XLP, and XLP is underperforming. Now, this is a moving average. Again, it's 50-day moving average. Doesn't have much meaning. It just gives you the direction of, of the relative strength. The dotted line is just a 25-day moving average, just to give a sense of taking out of the variation of the curve. Now, if you look at again, to the blue line, as you notice here, obviously the big money is buying staples, But look what happens here. There's a big sharp decline in relative strength. The red line declines. The relative strength declines below the yellow line. So that tells you that there is a big sales from people who know, people who decided that staples are not the way to invest in the market. If you notice here, the price, you would not know by looking at the price of XLP. You see, it stays fairly flat. So it tells you here, this trend, it tells you, look, yes, you're not losing money, but you are underperforming the market. You're better off either staying XLP or buy something else, because the way it is, XLP is underperforming. Eventually, the price declined because there was heavy selling on the staples. So the point is, of course, not all the charts are like this. I'd like to show you others, but this gives you the basic concept. Rising relative strength means money is investing in XLP, and XLP is outperforming the S&P 500. However, when big money is selling, even if XLP stays, the price stays like this, it tells you that they are leaving the market. So you have to be careful. Probably you want to reduce your exposure to XLP or sell it outright. Let's see other examples. This is the price of gold. The ETF is a IAU. And of course, the gold has been going up. And as you notice here, from this point, the relative strength has been going up. The dotted line is rising. The yellow line is rising too, saying that the momentum big time is shifting. And the price is start going up. It tells you that now this price is outperforming the market. That's the important thing. Big money is investing, relative strength is rising, the price is rising and outperforming the market. Now what happens here? Here you see that it went parabolic and there was a sharp decline in relative strength. And as you can see here, this weakness in relative strength tells you that gold is not going to do much for some time. So you probably either reduce or be aware that the relative strength is declining, and therefore there are other investments that outperform the market. But this chart shows another interesting technique. You see, at this point and this point, you can connect them with a trend line. So now you have an objective, okay? So let's move now to this point where the relative strength is increasing again. The relative strength is increasing. It means that with the price now going up, it's the right setup, rising relative strength and rising prices. However, now you have a trend line that is going from this point to this point, and now look where gold has reached that trend line. So that is a warning that says every time the price of gold touches this trend, probably there is going to be a correction, and it did actually. And by the way, we discussed this chart not only on X but also in our service. So in fact, here now you have pricing declining, relative strength declining. So that tells you that the gold is underperforming the S&P 500. So your alternative is either you stay with the S&P 500 or otherwise select other stocks. Okay, let's see some more examples now. This is the chart of Bitcoin. This is the price, and then flat since last June, July. And what I draw here is a line that is the previous peak to tell me an idea that the Bitcoin is likely to find considerable resistance at this level. Here again is the relative strength, the ratio of Bitcoin, the ETF IBIT, and the blue line, and here declining. Again, the same charts. Let's now interpret what this chart is saying. Here, in this period, is okay to invest in Bitcoin, but now the relative strength declined. Now here there is an opportunity. Relative strength rises and everything rising. The price now is moving up. So this is an indication that Bitcoin is going to outperform the market. So it's a good investment at that point. However, beginning now here is hitting resistance, right? Now you have this chart, this line drawn. So it's hitting resistance. And you see also relative strength is declining. So now as Bitcoin is not becoming the great investment that it was before. So the option, of course, is to reduce or otherwise wait and see what happens. But then here at this point, the relative strength really declines big time. So owning Bitcoin during this month is a waste of performance because the Bitcoin is underperforming now the market. So the market is stronger than Bitcoin. So you have a decision to be made. Do you want to be in an asset underperforming the market or not? This stock is Sterling Infrastructure. Is the ideal investment if you think about it, because here at this point a relative strength increases, goes above the yellow line, so it tells you that its momentum is changing, the price is clearly going up. So you have exactly what you can do is start now positioning with a small amount. Eventually, if you are right, you start increasing over time. Here, relative strength is perfect. Textbook trend. The price is textbook trend going up with relatively low volatility. What I've done here is to draw a trend line from the top, because I know that when it hits the top, there is a correction. And also as a risk management tool, and this is important, because when do you sell? Well, you sell when the reasons why you buy are violated. So you sell when the price declines and the relative strength declines. So as a risk management tool, I have this trend line, which is the parallel line to this one, and it hits this point and this point, and goes from this point. So now I know that if the price goes below this long-term channel, something is wrong. If in the meantime the relative strength declines, I know now that I have to sell. This chart as of now, it doesn't say that. So the trend is up, the price is within a channel, relative strength is rising, momentum is very strong. So it looks like a nice hold as of that particular day. Things can change tomorrow, and then you have to make another decision. This is another great stocks, and there's GE Aerospace. And of course, here the price is rising, the relative strength is rising. So now you is moving in a channel that you do see. Once it hits this levels, you can draw a trend line, and then you can draw a parallel trend line. But what you can see at the bottom, which is the important thing, you can see the relative strength is nice and rising. Here now the relative strength actually is flattening out, and the point, what that means is that now GE is behaving very much like the S&P 500. So is a nice stock, is rising, but what this relative strength is saying that if the market goes down, chances are that GE is going down as well. As always, I have this trend line here that gives me a risk management tool. If I see the price of GE declining, going to the below the lower this line here, if I see the relative strength coming down, that means big money is selling. So whether you have a strategy to manage risk, you may reduce your exposure to GE. This is the chart of IWO, the ETF, the Russell 2000 Small Caps Growth Index. And again, the interesting thing is that from April of this year, the relative strength has been rising and the price has been rising and has outperformed the market. And so this is a good investment. Now, what are the things to watch? As you can see here, the relative strength now has been declining. And what I've done for safety, for again, risk management, is try to draw a trend line that goes below these points. Now, if the price goes down and the relative strength keeps on going down, that is a sign that I have to be very careful. Maybe I should reduce the size of the position. Actually, one could also, if you are very prudent about your investment management, this is as you can see, is a fairly big sharp in underperformance with the price going nowhere. So you have to decide is if maybe reduce some money off the table, but always have a risk management concept ready to pull the trigger. In other words, the reason you're buying are the same reason, if they are violated, that's the reason to sell or to reduce the sale. So you buy something that rises in price and rises in relative strength. But if the price eventually declines with relative strength, you see, relative strength is always a leading indicator of prices. That's what is important, because the big money start selling into strength. That's what they do, because they know more than the average investor does. That's why it's important to follow this curve. So be prepared. This is what really this chart is saying. Be careful. This is the graph of SMH, that is semiconductors. Again, here in April, the price goes up, relative strength rises. That's where you want to go. Rising prices, rising relative strength. And let's say now you're here, but now you have enough points to draw this trend line. Then what you do, you plot a parallel line to that from this point. So now you have a channel within which the market has the semiconductors have performed since April. So for 6-7 months now they have been in that channel. What is important is now you have a risk management tool, because if the price goes below that trend line, that is going to tell you something. And also, of course, you have to have a decline in relative strength, which is not happening. That meaning that big money is not selling. See, even here, the trend has changed in relative strength, but has not been declining. So during this time, the SMH has performed like the S&P 500, but really there's not big selling from the people who know. Then finish that period in September, they start buying heavily again, and the price goes up. So the setup is so far is okay. But again, I'm really I have this idea that I have to have in mind the risk management, because that's in my business. When I had associated with a large corporation, my job was to make money, but especially not lose money. And that's why I always have a risk management concept in my mind. And this is if prices decline and relative strength declines. Now, the previous example of charts is not buy or sell recommendation. Absolutely. They are just examples of how to analyze a graph using prices and using relative strength, where relative strength is defined as the price divided by the S&P 500. If the relative strength rises, means the big money is buying that particular investment. If the relative strength is declining, means that the big money is selling that investment to buy something else. So this is why the relative strength is a important concept, and especially you want to be in stocks with rising relative strength. And the reason is simple, because if you don't buy stocks that are rising faster than the market, then your second best option is to buy the market, which is SPY. Of course, you also want to invest in something that goes from the lower left to the upper right. That goes without saying. And of course, the condition for selling are exactly the opposite. If you see the declining relative strength, and usually that leads the price, and you see then rising price, you should start reducing your position. Usually when the relative strength declines, that's when you start reducing the position, because you know the declining prices is coming when there has been enough selling. I guess what I've been saying here is you have to have an idea in the investment process, whatever that might be. But I think it's important to have knowledge of where you are in the business cycle. Is the economy strengthening? Then you have to be in cyclical stocks. Is the economy weakening? Then you have to be in defensive stocks. Then the use of timing indicators is very important, because it tells you how aggressive you can be. And quite frankly, I can say that we have several that are fairly not perfect, but give you a good sense of the direction of the market. They're all technical indicators based mostly on advances, declines, volumes, up volume, down volume, new highs, new lows. Is a combination of all these measures. And if again, and then entering a position with rising relative strength, because that's where the big money shows where the big money goes. If the relative strength rises, the big money goes there. If it declines, that means that they're selling, and you should sell as well. And again, the main indicator is the relative strength. If wherever it goes, that's where you should be. Of course, it helps if the price rises. That goes without saying. Well, I hope you found useful all this example in this discussion. Of course, in our site, we show several of these videos, educational videos, market updates, of what indicators are saying about which sector should be stronger or weaker. So this is a fairly strategic type of information, but also we go down to recommending timing. Is this the time to buy, or this is the time to sell? What are the markets are saying about it? Of course, with all our stock recommendations. Again, thank you very much for following us. I hope to see you really, really soon. So long. Take care of yourself. These are the books that I wrote. The Profiting in Bull or Bear Market. This was commissioned by McGraw-Hill, and they distributed also in Asia. As you can see, these are the Asian version of the book. I had some excellent reviews for the material that I covered. This book here, Easy Ways to Beat the Market with ETFs, is a study really of moving average. What are the best moving averages? By the way, the outcome of that is a series of portfolio based on moving average, and also our long-term timing indicator, which has tremendous performance with much less risk relative to the market. We show all this information on page 3 of our service. And then the third book I wrote is Investing Wisely. It's Easier Than You Think. And it's about a summary of all the information that what I knew at that time, which is the whatever is in this book and in this book.